Thank you, Jason Douglas, The Wall Street Journal. Governor, can I just ask you, in the Q&A at the end, you talked a little bit about how you thought that the non-oil economy might help pull the economy through towards the second half of the year. Could you maybe just give us a bit more detail on where you see some of the momentum in the non-oil bits of the economy and how they're going to offset what's happening with the oil sector? Thank you.
Yes, well, we're seeing good momentum in several pockets of the manufacturing sector. These are and other areas such as building materials. These are packaging materials. These sound like kind of tame things, but they're pretty important categories that are connected to the investment story in the U.S. So when investment picks up in the U.S., which was a bit of a weak spot in the recovery until last year, when that picks up, we get a bigger impact on our trade story than we do in the earlier phases of the recovery. So you've seen a number of material announcements, just by illustration, in the auto sector, in plant expansions or upgrades in Canada, new employment by certain automakers, and that, of course, feeds the suppliers, and we get a nexus there. There's good move happening in the forestry side. So there's a number of stories like this which are gathering momentum, and as I said in the Q&A, give or take around 5% growth of that export-oriented GDP, which is kind of a tricky calculation, not an official one. It's just one that we try to mock up, and that's very encouraging. It's got good upward momentum, and we believe the U.S. has got momentum. It will continue.
Do you have a follow-up?
Sure, thank you. And on the first and second quarters, then, do you think the economy could even contract? Is that sort of penciled in?
Right now, I couldn't really say. We don't offer a running commentary on the data. They've been on the soft side, of course, for two reasons. We're expecting some of this because of the oil shock, but also some extreme weather effects in some parts of the country. So and just as with the United States, it'll be hard to disentangle everything for a little while. I wouldn't want to guess whether we could go all the way down to zero or negative. I just think it's going to be a pretty low growth quarter, and we're hopeful, therefore, that means that the shock is mostly front loaded, and therefore that what we're seeing is not signs of a larger shock, but an earlier shock. And that means that the other things that we can see that are positives are more likely to be more prominent as we get into the second half of the year. And if we get lucky, it'll be sooner than that.
David Milliken.
David Milliken from Reuters. Just following up on that, I was wondering if you could say a bit more about how likely you think it is that growth will be sort of weaker than 1% in the first quarter, and whether that is something that would make you want to consider taking more insurance, as you put it.
Well, as I was just saying, it could be. We in the NPR of January, we put it in as 1.5. The numbers that have come in so far kind of look on the soft side of that. I'll say this much: we haven't done a new forecast yet. But I think that what's more important is that I would interpret it today as either a weather effect, which of course would be one-off, or the oil shock hitting bigger earlier, as opposed to it being a bigger shock. And if it's earlier, that just means that it's over sooner. And so it would not necessarily change our thinking about that insurance question. What we need, though, is a longer string of evidence to sort that out. And what matters over the longer monitoring horizon is not just the negative part, which of course we can put our finger on, but the positives, which are from a little more consumer demand from the windfall from oil prices, and higher exports from a stronger U.S. economy, and a lower exchange rate. So those things together should be showing up through the same period, and we have to monitor them individually, and it'll be about how that balance is working out, and we can't predict that.
And just to follow up on that, I know that you said you were comfortable with the insurance that you've done so far. Does that mean that markets are right in thinking that, barring some sort of unexpected disaster in the data over the next couple of weeks, a rate cut in April is really pretty much off the cards?
Well, I'm not going to comment on a specific interest rate outlook, but in terms of the economy, the sorts of things that we have to look at is you know, how is the oil price behaving relative to the assumptions that we have built in, and how is the economy responding? And so that's going to take time. That's why I purposely use the term insurance and the term buy time, because we need time. We know the direction, and we need some time to assess the relative strength of those effects. And we measure this time not in days or weeks. It takes a little more time than that. We're just now getting some data from January and February. It's going to be more time before we'll know how the economy is actually responding.
Scott Hamilton.
Hi there, Scott Hamilton from Bloomberg News. Why is Canada failing to follow the pace of the US recovery? Are there signs that a historical link has been broken?
Yes, essentially, what we've seen over the past almost 3 years now is a bit of a wedge between the U.S. economic performance and our export performance. And that wedge has grown to the point where when we did the fulsome analysis of it, it reached about $80 billion on missing exports, if I could use that term. And so in-depth analysis of that showed us that much of that, say at least 40% of that, we could ascribe to companies that actually closed their doors during the weak export period, and therefore would be very unlikely, of course, to respond to the U.S. recovery. And so in our forecasting, then, we take that into account now, and we don't assume that it reverses. In fact, we assume it's permanent for now, and we hope that over time we win some of that back through a longer time period. So there has been a disconnect. The connection has gotten a little stronger over the last 12 months because the U.S. recovery has entered an investment phase. And the investment spending on the two sides of the border are closely linked. Companies that are cross-border companies. And a lot of our suppliers supply U.S. companies in the investment space. They're not necessarily direct consumer linked companies. So we get a stronger elasticity from the U.S. recovery when it enters the investment stage, and as well government spending. So those components which were weakest during the downturn are now strengthening, and we're getting a little bit more. And so, as I said, we're quite encouraged by the export picture as it's shaping up. It doesn't go in a straight line, but it's obviously much better than it was a year ago.
Thank you. And core inflation has remained above 2% for half a year now. Does that give you hesitation about how much stimulus you can push into the economy?
Well, core inflation is 2.1%, and there are some significant things in there that we need to see through. They're idiosyncratic or they are exchange rate effects. So idiosyncratic includes meat prices, which went up a lot last year, and telecommunications prices that went up a lot last year. Those will run out a little later this year. And as well, the exchange rate effect, which now is on the order of 0.3, possibly 0.4%, is also a temporary phenomenon. So as it works its way through, there'll be a bit of a bulge in core inflation, and then it will run off. So for us, underlying inflation is around 1.6, perhaps 1.7%. The economy still has a large gap, so it has excess capacity, room to grow. And until that gap is closed, there will be the risk of declining underlying inflation. So we have to continue to see through those things to make those kinds of decisions.
David, over here.
Thank you. David Robinson, Market News. What are the risks of having your monetary policy heading in the opposite direction to the US monetary policy? What are the risks associated with divergent monetary policy, if any?
Well, the premise begins in an unusual situation. If we were in a normal situation where both economies were in equilibrium and we had inflation on target in both Canada and the United States, and an oil shock came along like we just had, my guess is there would be a divergence. And that's just what central banks do, and markets would need to understand that we're targeting our inflation rate, not somebody else's. And so I think you have to focus on that and try to distinguish that from the bigger story, which is that the U.S. has been at zero interest rates for some time, and if we are getting close to where the first steps towards normalization happen, it'll only be good news for Canada. It'll mean that the U.S. recovery is clearly sustaining, has got momentum, and so that will be good for us at the same time. So the two economies remain in sync in the big picture. It's very common, very highly correlated, but there will be times when they diverge. But those are usually fairly temporary things. So I don't think it poses a significant risk to us. We will have an independent policy aimed at our inflation rate, just as the U.S. would have.
Catherine.
Hi. I was wondering if you could address the housing market situation. Obviously, you've expressed a lot of concern about that in the past, and particularly with what we're seeing in Alberta now. I was wondering if you have any further thoughts.
All right. So the housing market remains our key vulnerability, as we outline in our FSR, our Financial System Review. It's a vulnerability, which is a little different from a risk. Normally when we have vulnerability, we ask, well, what would cause that vulnerability to emerge and make it more real? And that would be a shock of some kind, such as one that causes unemployment to rise, let's say, and makes it harder to service mortgages. And that's exactly the shock that we've got here. So the oil shock is not universal, but it is pretty significant in certain parts of the country. And so we are already observing a noticeable impact on house sales and renovation activity and that sort of thing in Alberta and in Newfoundland, Saskatchewan a little less, but still. And so those are things that we have to monitor carefully. But these are regional markets. The overall market has been a strong one, but there have been, there've only been pockets of vulnerability, if you like that. And Calgary obviously was one. And so we monitor that carefully. But we think that what remains is the fundamentals for Canadian economy continue to strengthen. Employment will continue to grow after we're through this oil shock. And with that, you strengthen the fundamentals of the housing market steadily through time. When you have people who are unemployed or underemployed, that doesn't give you a strong foundation for growth in the housing market. As that goes away over the next 2 years, the housing market can only improve.
I mean, in terms of household debt levels, do you see those as confined to sort of regional areas as well, or is that a more broad-based problem?
Household debt levels are, again, yes, they are. They do have a regional dimension because they are closely related to the price of housing. So when we've studied the demographic profile of people, and we discover that, in fact, the young cohort does not carry much debt at all until the day they buy a house, and then they have a lot of debt. So they cross that threshold when they buy the house because the house is expensive. They have a big mortgage, but of course they have a big asset to match that debt. And so it's as we go through this, as that happens, the debt to income ratio that we look at is 160-odd%, which is big in a macro sense. And as we said, that the oil shock would actually make that worse because it would lower aggregate incomes. And so our interest rate shock our interest rate adjustment is intended to mitigate that to some degree because it'll cushion the amount by which incomes fall. So that ratio won't go up as much, even though there might be some more borrowing at the margin. It's complicated, two things happening at once. But in the end, I think that the most reliable way of making that whole situation more sustainable is to do everything we can to get the economy back home to where we are operating at full capacity and full employment, because that will strengthen that ability to carry debt and to own homes. And until that happens, I think this vulnerability will remain there. We have to continue to take it into account and be sensitive to it. And it's a very real issue for sure. But if we'd gone through the last 5 years without that, we would have just had a really long recession in Canada. Because the exports really went down a lot, and it was only household spending that filled that gap for us and gave us one of the best post-crisis experiences. That's the cost of that is this accumulated imbalances, but it's just like a side effect of a policy cure, which was essential.
Any other questions?
Governor Anirban from Reuters. Just had a quick question for you. The Chinese have ramped up their rhetoric about inclusion of the yuan in their SDR, in the IMF's SDR basket. What's Canada's view on that?
Well, I don't have a view on that. That's not a Bank of Canada file. Anyway, the IMF reform, right, the quota reform, which is still pending, would, of course, have elements of that in it. But I have no comment on whether it's a good thing or a bad thing, or just waiting to see.
David Barwick from MNI. How concerned are you about the ripple effects of a possible departure of Greece from the Eurozone?
Sorry, about the partial?
About the ripple effects on the wider financial system of a possible departure by Greece from the Eurozone.
Oh, I see. Well, any financial shock that could cause ripples through the world system is of concern to us, and we're watching that situation closely. I can't really put a measure on my level of concern. I'm concerned, and of course hope that everything turns out for the best and we don't have yet another shock to deal with. Central banker's life is full of shocks, so it's what we do. But I certainly hope that all turns out well.
So if there are no further questions, we have time for one more? Okay. Last question.
So yes, he was going back to the financial stability considerations. Actually, you've mentioned several times in the speech and just now. I mean, does that factor in at all on the pace of the Bank of Canada's normalisation, policy normalisation? Does it have any bearing at all?
Yeah. Well, I think in theory, it is something that we all talk about. That we have to believe that when you go through a long, drawn-out cycle like we have, and in many cases, including our own, it's been the household sector that's done the heavy lifting of expanding their indebtedness in order to spend and keep us afloat, that creates these imbalances. What that means then is when interest rates someday begin a process of normalization, that will be felt more acutely than if that had not occurred. And that goes along with the observation I made in the room, which is that we believe that the equilibrium or the neutral rate of interest is gradually working its way downwards for the reasons I mentioned in the speech. And so there's every reason to believe that when interest rates globally begin to edge higher, they will go up slowly for this reason, and they'll have a lower destination than we used to think. So I think central bankers in general agree with that, and but it remains to be seen, how all that works. And it seems to be, a topic which will require a lot of research and understanding, and more, if you like, feeling it as you go kind of thing. So I think that you've had your finger on an important issue, but we can't forecast it all.
So that concludes the press conference. Thank you all for coming.
Thanks very much.